e-learning, and I want to go to the step acquisition. And that is the question that I'm going to open, and we are going to do it. We'll do it slowly. Let me see. This is 100,000 shares of one. Yeah, we'll do it slowly, but it has all the steps that are necessary, because it comes from an associate to a subsidiary, then it increases interest to a subsidiary, no change of control, then there's a reduction, and there's no change in control. So I think it's a fairly good. If you can understand the concept, then we'll be fine. Then ideally, you should be able to do any question on step acquisition. So here we are talking of Soliv, purchase shares in YMAS as follows. So on the 1st of January 09, they bought 20,000 shares and they paid 60,000. On the 31st of December 2011, they bought another 35,000 shares for 320. Then on 31st of December 2013, they bought another 25,000 shares for 270. Then on 31st December 2015, they disposed of 20,000 shares, meaning they went down to 60. And note that on 31st, the 20 were disposed of for 250. So ideally, they are saying they sold off 20,000 of their shares or their interest, and they received 250,000. Then additional information, if we go through it, it says, YMAS share capital consists of 100,000 ordinary share of $1 each. So it is the ordinary share capital is 100 times 100,000, and there has been no change in share capital since the company was incorporated. So it has always had 100,000 shares. Then the parent prepares consolidated, or the investor prepares accounts on 31st December each year, and its share capital consists of 200 ordinary shares of $1.50. So that tells you the ordinary share capital, as far as they are concerned, is 200,000 times 1.5. So if you look at the statement of financial position, you expect to see their ordinary share capital reflected as 300,000. And there has been no change in shares since the company was incorporated. Then we are told the reserve at 31st December 2011, 2013, and 2015 reflect the fair values of assets of both company at those dates. So we are basically saying the carrying amount in the assets and liability is equal to the fair value of those assets and liability. So there are no fair value adjustments, which would complicate. Okay, then we have been told non-controlling interest is valued at their share of net asset of the subsidiary. So ideally, they are saying in computing non-controlling interest, they are using the partial method. And the partial method is where we use the proportionate of the net asset. The advantage of that to the NCI is that whenever profit or loss is made from the group, if there is an impairment of goodwill, that impairment is fully borne by the parent. Of course, then the profit after tax of Weimar for the year ended 2015 was 150, and Weimar did not pay a dividend during the year. So Weimar is a company that is an investee. Is a company that eventually becomes a subsidiary. The profit after tax for the parent for the year ended was 300,000, and they paid a dividend during the year amounting to 50,000. And this parent company has no other subsidiary and has only the above reserves in the books. So all the information is represented. So we are required to calculate the goodwill arising on the acquisition of WIMAS and prepare the relevant consolidation journals. So we will start from the day of inception. Assume this transaction when they acquired, number of shares, reserve, and so forth. What do we know the fair value of the assets just before the acquisition? Anyway, the fair value is equal to, they have said the fair value is equal to, those things are the same, but we don't know now what the previously held investment in this case was here. We haven't been told. This we must reserve. This is the cost. This is the number of shares. Okay, I think this question I would have wanted to see because when they acquired the 20,000 for 60,000, when we are basically saying the 60,000, when it becomes a subsidiary, because there it became an associate, on the 31st December 2011, on the last day of the reporting, they acquired an additional 35,000, which is 35%, and therefore it became a subsidiary. So the first thing is to know, I don't know, this question is a little bit defective, but let's see. What would have happened in the first? I'll open journal entries, then we'll work on journal entries. What entries they would have passed. If there is any defect in the question, then we shall address it. So as usual, I'll open Excel. You know, I like Excel because I don't want to confuse students.
Excuse me, Doctor.
Yeah.
Are you presenting something because I'm unable to see your screen?
Yeah, you are using a phone. Others are seeing.
I'm using a laptop.
Yeah, are the rest not seeing what I'm presenting?
We are. Just leave and log in again. You should be able to see.
Yeah, it should, because I'm sharing my screen, so they should be able, unless they have a problem on their side. So what I'll do, I will do just an entry just to see what record they would have recorded, and then what's happening there. I'll just do some journal entries just to be. Yes, I'm just doing some format of journal entry just for us to understand how we do the journal entries. Okay, assuming this is a journal entry book, I'll just keep changing them. So we are saying on the first day, I'll keep moving to the question. They are saying on the first, when a company makes an investment, we say the initial recognition, according to the conceptual framework, any time you make an investment, whether it is an asset or what, we always assume that what you have paid is a fair value because you are a rational person. And therefore, initial recognition is always at cost. So ideally, they would have recognized. Remember, we are in 2015, according to this. So I don't know whether. So I will make an assumption. Accordingly, today, they would have had the accounts a little bit, and they would have said investment in YMAS. Normally, they don't say investment in associate because associate is more of a determination based on the level of control. That's what they would have said. That would have been, this is the ledgers. I think I should do the double entries. It should be, how do we do journal entries? Normally is 3 accounts. I wanted to do, but I'll put the ledger because there's something I want us to understand. So in terms of the journal entries, I only need 3 accounts. If you are told do journal entries, of course it has a date. Let me put the date as well. When you talk about a journal entry, it should have a date, a description, a credit, and a debit. So ideally, that's the format of a journal entry. But now, if we are, I don't know whether we are dealing. So let's say we have the date, we have the description. The description basically talk about the nature of the transaction. So we are saying the cost center or a description of that, and then we always have the amount, which is the debit and the credit. Of course, we must always determine our unit of account, whether we are using dollars, thousands of dollars, how we record them. So on the first transaction, which was 01/09, I'm not sure whether that is correct. So basically, they were going to record the investment in the company. We cannot say investment in associate, because associate is a determination based on, and of course, we are going to recognize it in their payable or cash. I don't know how they could have paid it at the time. And then, of course, we are told what they did. They paid 60,000. So that would have been the journal for 20,000 that they would have recorded at that time. But we are down into 2015, so we don't know. But let's work out on the second date, on the 31st of December. Of course, it became an associate. So just before it becomes a subsidiary, we are saying we should have recognized between the 1st of January 2019 and 31st of December, there was a 20% qualify as an associate, and therefore we should have been recording the gain or loss by debiting investment in associate and recognizing the retained earning. And that is from the book of the investor. So ideally, we are saying on the date of acquisition, on the first date of acquisition, the YMAS retained earning were 250. Then by 31st of December, the retained earning had grown from 250 to 650 to 600. So if you look at the growth there, so we are saying between 1st of January 2019 and 31st of December, they should have recognized some gain. So we can go and see what gain would they have recognized. We'll put it on 31st of December 2011, doesn't really matter. So we are saying would have recorded some investment in the companies that we have invested, and this should have gone to our retained earning. Retained earning, of course, we take it to the profit, but I'm using retained earning because we are not in that specific year. So you take it as an income from associate, and then it closes into retained earning. And how much is it? We are saying it is 20%, which is 0.2 times the growth. And the growth we are saying, based on these figures, that it has grown from 250 to 600,000. So that is the income we would have recognized. So we are saying it is 600 minus 250 at the first initial date. So if we work out that, that would have been what we would have recognized as an investment, would have increased our original investment. This was not 20. I think I've picked the wrong figure. The investment is 60,000. Not 20, this is 60. And then here we are saying they would have increased the investment by 70,000 and credited their retained earning by 70,000. That is associate income from associate. I'll call it associate income over the years. On this date, now, they also invest on the 31st December 2011. They also have another investment now, which is in cash, to acquire for it to become a subsidiary. So if you look at it, they bought another 35,000 and paid 320,000. 320,000. So we are basically saying on that day, they would have said investment again, which they have paid in cash or payable. And then this would have been either cash or payable. I like using the payable, and that amount would have been recognized in the account. as 600,000 because the cost 320. This is 320. Are we fine so far?
Doctor.
Yes.
Sorry, doctor. That retained earning investment in WHRS 70,000 and retained earning 70,000. How do we come by that, doctor?
I have said that from the first inception, if you look at the financial statement, when they acquired 20,000, 20,000 is an associate, and the retained earning at that date at the investee was 250. So what growth in retained earning is the profit that is retained. When an associate make profit, what happens? You recognize. Did they get? No, it wasn't 70. Yeah, thank you. We are saying there, this company made profit between 2009 to 2011. What the difference between this? And that profit, I think, is what we have said. 20% of that profit is attributable. Should have been recognized using the equity method, as 20% of the gain on associate would have appeared every year. And therefore, we are saying 70,000 is 20% because they owned 20% at that point. So if you take 600,000 minus 250, you get 350. 20% of that is 70,000. That's how we got the 70,000. And then now they do another investment. And then we are saying at this date, that's what we are now saying. This is the date when at this point, it becomes an associate. So we are saying, if you look at the investment, and that's why I want to say investment here, would have recognized the 60,000, would have recognized the 70,000, and we have recognized the ones we have added, 320,000. So we are basically saying that the total cost on the investment account would have reflected 450,000. Basically, that's how in the separate book of the parent, the books would have showed investment in this company is 450,000. Ideally, at this date, we are supposed to go and see the previously held investment, the 20%, which they had paid 60,000 and has grown by another 70,000, and therefore it is showing as 130,000. We were supposed to go and verify what the fair value of that previously held investment is. In the absence of further information, we'll assume that this is the 130 fairly represented the fair value at that time. However, sometimes you are given the fair value. Then if the fair value is 150, then you can see there is a shortfall of 20,000, which would have been added as an investment and credited to the retained earning. Am I clear in that point?
Yes, doctor.
Yes, and the rest, because we said one of the steps is to revalue previously held investment. In our case, the previously held investment before the investment that brings it under control is only the 20%, which they had paid 60,000. But that 60,000 should have grown by another 70,000, and therefore its value in the book should have been 130. And that is the figure now we would have compared with the previously held investment and made adjustment if it was possible. Based on this question, I do not see the previously held investment as at that date. Then we would have made adjustment. So we are saying on 31st December, that particular time after they made the investment of an additional 35, therefore, they now control 55. That is the date of acquisition. On the date of acquisition, then what happened? We are supposed to determine, we can determine value or our asset and liability at the fair value introduce NCI, and those are pro forma consolidation journal. So let us introduce them. Let's say now it has become an associate. Now it has become a subsidiary on the 31st. And what is the associate saying? When it becomes a subsidiary, those entry will be eliminated with the share capital. So on this particular day, which is also 31st of December, 2011, we need to determine to eliminate the investment and the equity of the subsidiary. Of course, after reinstating our asset and liability. So if they were not fairly valued, we would have made first an adjustment to the asset and liability. If the previously held investment needed an adjustment, we would have done that adjustment. But we are saying now, we are assuming the previously held is at the fair value. The asset and liability, we have been told they are at the fair value. So on the date of acquisition, we make a pro forma consolidation journal where we introduce, we eliminate the equity of the subsidiary, which is the ordinary share capital, which of course would have been eliminated in the computation of goodwill, which I'll do now, and the retained earning at the date of acquisition. And we eliminate the investment in the subsidiary. Now we know it's real. This investment we know is 450,000. So that if we credit 450 here, this account closes and doesn't appear anywhere in the books in the consolidated financial statement. So we will eliminate this 450 by eliminating the equity, which is represented by the ordinary share, which we are told is 100,000, 1, 2, 3. And then the equity is also represented by the share, the retained earning at the date of acquisition. So the retained earning from this date, we can see on the date of acquisition, the retained earning is 600,000. So we can eliminate the retained earning is 600,000. 1, 2, 3. Then we are going to introduce an item called NCI. And NCI is going to be the equity not represented, and we are valuing it based on the net asset. So we know the parent now has 55, and therefore the subsidiary is 45%. That's why I put 0.45. Then we multiply that by the net asset at the date of acquisition. And the net asset is made up of 100,000, which is the ordinary share capital, plus the 600, which is the retained earning. So that becomes our non-controlling interest at the initial, we call it initial recognition of NCI. And any difference, we take it either, if it is positive, we take it to goodwill. If it's negative, we take it to the retained earnings. So we can work out, we see this 700, and this is, let's work out what the figures are. Just one moment, and my mouse is misbehaving. Well, I have fat fingers probably. Yeah, no, I think it's working. So we are saying this is, if you look at the total there, this is 765,000, and this is 700. So we are saying there is a difference, a debit difference, which of 65,000, which we call goodwill. Ideally, that is the idea. So you can calculate goodwill if you, this journal also is a journal that calculate goodwill. So you can see now the debit side is 765,000 and the credit side is 765,000. So if you are to pass that, then we are saying you put 450, nothing would appear as investment. And that's what we said in consolidation, the investment in subsidiary is eliminated with similar item, and the similar item is the equity of the investee. So ideally, that's the second step. So at this point, we have established what goodwill is. So we can continue in the next and see what happened now between.
Doctor,
Yes.
I'm a bit slow. Maybe if you could just explain again, what is the purpose of us preparing that journal entry?
What is the purpose?
Yes.
This is a pro forma consolidation journal, and the purpose of this journal is to, sorry, I think I put the wrong mark. The purpose of this journal is ideally to, for the purpose of consolidation, because we said we eliminate similar and opposite item. So when a company acquires a company, so what they are basically acquiring is the asset. So that asset called investment in this company represents the asset that they are acquiring. And since we are going to integrate the asset into the consolidated financial statements, then showing an investment would be a duplication. So we are going, if they had PPE, we are going to add PPE as an asset in the consolidated financial statement. So we are saying this investment basically represent the very same asset, which are represented by the equity of the subsidiary. And therefore, this journal will always, it will not be captured by any company, but it will always be done before any consolidation is done, because it's not an entry for any of the company. The parent will still have the investment in subsidiary, and because but for the purpose of consolidation, we will have to eliminate that investment by the equity, which represent the net assets that have been acquired, so that we eliminate what we call similar and equal items. The purpose of it is to enable consolidation to eliminate similar items. Okay, so that is the journal. So at this point, if we are to do consolidation, there will be nothing called investment in the subsidiary, because we'll only have goodwill and NCI, and then we add all the other asset and liability we combine for the two companies. Okay, now we go now. This company has become a subsidiary on the 31st of December 2011. Now they are saying between 2011 and 2013, the company has made profit. What normally happens when it makes profit? Remember, we always combine the total revenue and the total cost of sale, but in the end, we always look at the profit of the subsidiary and share it between group and non-controlling interest. So ideally, we are saying between 2011 now and 2013, before they made another investment, that the company made profit, and that profit is represented by the growth from 600 to 1.1. So we are saying the subsidiary made profit of 500,000 between December 2011 and 2013. And as we know, in the consolidated financial statement, profit made by the subsidiary is attributable either to the group or to the NCI. So we need to attribute that profit respectively to the group and NCI. So we know it is 1.1 million minus 600, because at the date of acquisition, the retained earning was 600. So we can go and say now, 31st of December 2013, we are saying there is profit that was made. So remember, when we are doing consolidation, we eliminate the 600,000, which was the retained earning of the subsidiary at the date of acquisition. So in the subsequent thing, retained earning must be moved either to NCI or to the group, and that's what we are doing. So we are saying we are going to remove the retained earning of years. This is post-acquisition earning. This is after it became a subsidiary, and we are saying that amount is 1.1 million minus the 600,000, which was in existence, which is 500,000. And that amount is going to go to group. I'll call it group retained earning and NCI. The group is going to take a proportion which is 0.55 because they became 55%. And that is of the fee 500, 1, 2, 3. That is what the group will get. And the NCI at that point is 0.45. Of course, times the 500. So that is how the profit will be shared between the group and NCI. I'll extend this just to be... Okay, so that we are saying, if you look at NCI, let me now introduce here. We are saying, I'll introduce two accounts. I'll call one, this is investment in what we've been calling it in associate. Of course, we don't indicate. Let's introduce another account called NCI, and then the group retained earning. But the group retained earning and NCI, the group retained earning also has other amounts, which are basically from the group retained earning, and NCI has particularly other income from other groups. And basically what I'm saying is that in here, we are basically saying in the NCI, during using the pro forma consolidation journal, you will, of course, when you eliminate this before they are eliminated, you will introduce the initial NCI, which we introduced here, which is 315. That is the initial. That I put pro to mean it's a pro forma journal entry. That's the initial recognition. That's what they call it in the conceptual framework. So the initial recognition of NCI is the 315, which is 45% of the net asset at the date of acquisition. Then we are saying up to 31st of December 2013, they will get an additional amount, which is 225. And for the first time, the group will get up to December 2013, the group will get the post-acquisition earning, the first post-acquisition earning of 275,000. So ideally, that is how the ledger would look like. Now, on the 31st of December, and that is where the gist of the matter is, let's go to the question. We are being told on this date, meaning, of course, everything earned up to that date was the group was 55%, the NCI was 45%, because the group was 20 plus 35, that is 55%, therefore NCI was 45. On this particular day, after when you are closing the books on the 31st of December, now they want to acquire another 25%. So what will they do? Let's talk about it. What journal will they pass here? To acquire this amount, of course, they will record on 31st of December. They will record an investment, which is of that amount they are paid, and they probably it will be a payable as usual. I'll put as a payable, and the amount is they paid 270,000. So they are going to record 270,000. So that amount will also be recorded here as 270,000. But what you notice is that whereas when we are doing, let me give those a different color, just for us to know that whenever we are doing a pro forma consolidation journal, it will only eliminate the investment that was in existence at the date of acquisition. So this is another acquisition investment which happened after. So when we are doing consolidation, we are not supposed to have investment in associate, yet we have now an additional investment of 270,000. So how do we do it? How do we eliminate this 270 in doing consolidation? Because this one will have been acquired. But we said that there is no change in control. They are only moving from 55 to 80%. So control is maintained. We don't calculate goodwill, but NCI is going to reduce from 45 to 80% from 45 to 20%. Now we need to know, how do we allocate that? Because another pro forma journal entry that we will need now when we are preparing consolidated financial statement on that date is to eliminate the investment. So we are saying here, we will eliminate the investment. I'll put the investment is a credit. The investment that they have made is 270,000. So that this amount is also eliminated. And I give it a different color. That amount need to be also eliminated in the consolidated financial statement. But there is no net asset. There is no equity to eliminate it. We only eliminate it against the NCI, because basically we are saying NCI is going to reduce, and therefore we are saying this NCI now, these are the two NCI, and we can see the figure. Let me put a sum there. We can see we are saying that is the NCI. As at that date, NCI represent 540,000. This 540,000 is 45%. Let me put it's 45%. So we are saying NCI at this date is 45%, but we want to reduce this NCI to 20%. So how do we calculate how much of it need to be reduced? If 540 is 45, how much is we need to reduce by 25%? So we need to work out what 25% is. How do we work it out? We can basically say 540,000 is equal to 45%. So we want to find out what 25% is, because that is what we need to remove it by. So we can say that is equal to, we can basically get the 540 divided by this amount, 45, then we multiply by this other, not that one. We multiply by, is 25 we are looking, I think there. So we are basically saying of this amount, 540 is 45%, represent the net asset of 45%. But now NCI is selling their disposal, they are disposing of 25%. And that 25% is basically 300,000. So if we remove NCI by 300,000, here we are saying we will use the investment, which is what we are going to reduce. We are going to reduce the investment here in the journal. We are saying the NCI here will need to reduce by 300,000. Basically, we are now saying that we will debit NCI with 300,000, and the balance then will be 240,000, and 240,000 represent the 20%. That's basically what we are saying. And how can we prove this? We can look at the net asset at that date of the company. So we know the net asset is made up of 100,000, which is ordinary share capital, and the retained earning at that date. The retained earning at that date, which is given on the date of, is 1.1. So the retained earning on that date is 1.1. So the net asset for that company at that date is 1.2. And therefore, if you want to find what 20% is basically 20% of 1.2. which gives you 240. So we are basically saying we are going to reduce our NCI from 540, which represent 45%. We reduce it by 25%, which is 300,000, so that it remain proportionate of the 20%. And therefore, we are saying in here now, ideally what it is showing here is that the company has bought net asset worth 300,000 and they are paid 270. So what does that represent? It represents a gain. So basically, we are saying the company, by acquiring the extra shares, they have gained a net asset worth 30,000. If they had paid, let's say, 320,000, then it would have been a loss. And therefore, the retained earning would have reduced the group earning. And therefore, we can come up to the group retained earning, and we say this is additional movement in reserve. So we recognize an additional 30,000. And NCI here, we are going to remove the 300,000. Of course, this will be eliminated with this entry in the date of acquisition. So that is the entry that recognizes the movement in reserve. You can see the NCI has reduced by 300,000. The investment in associate, of course, reduced by 270, and the difference move into the retained earning of the group. That's why we say the change does not lead to recomputation of goodwill. It just leads to a movement in reserve. So if we are doing the statement of changes in equity, we would show 300,000 and 30, and the net is 270, which is offset by the investment in associate. So that is how we recognize on that date that movement. So let me move it up. I was just thinking probably it could also have been the other way around, where you debit the retained earning. But this is a gain. So it can result in a loss. For example, if they had paid more than 300, then it would have been a loss. So we'd have debited the group retained earning. But now they paid less than the equivalent of net asset, and therefore it is a gain. Then we go back to the question. The question now, we are saying now between December or from 2014 to the end of 2015, what do we need to do? Let me see. We are calculating the goodwill arising on the acquisition, I think, in the consolidation journals. So goodwill we have already calculated. We are doing the journal, and we are to show the extract of the statement of changes in equity for solely for the year ended 31st December 2015. So we are saying the trouble is we need to separate 20, because we want to show the movement in the retained earning. The movement in the retained earning only show the balance brought forward and the movement for the year. So because we are talking about 2015, we need to separate this in terms of the group here, in terms of the subsidiary. So we are saying from the date of they became 80% to the beginning of 2015, how much did they make? We are saying to the end of 2015 is 1.5, but how much is it up to 2014? So we can read how much they made. So we have been told the profit after tax for the year to 2015 was 150, and they did not pay a dividend during the year. So from 1.1 to 1.5 is ideally 2 years. But 1 year is prior year, the other year is current year. We want to split. So we have been told here there is 150 in this year, and therefore we can work out what the balance is for up to 2014. So if we remove 1,500, we remove 150, it gives us 1,350. Then 1,350, we subtract the 1.1, gives us 250. So we are saying the 400,000 which are made between 2013 and 2015, 250 were made in 2014. And that is what we want to share now. Then the profit for the year, will have to be shown in the movement in reserve during the year. So let's go to 2013, 2014 and see what journal would have passed. So we already know we'll pass a journal similar to sharing the group retained earning. We'll pass a journal similar to this. Sorry, I like shortcuts, but this is 2014. I want to do up to 2014. And we have said up to 2014, the group is 250,000. That's what we are doing. But here, the group, this is the group retained earning. At that time, the group is 80%. Is 0.8 and is for 250. That is the amount. And then here, we are saying the NCI has reduced to 20% for the 250. So we are saying if we share this group profit for 2014 between the NCI and the group, we are basically saying the group will going to receive 200,000 and the NCI will receive 1,000, being 80% and 20%, because that is the interest. And therefore, we could come here to the group and we put the 200,000, which is what they earn. And then we can come to NCI and put what they are entitled, which is the 50,000. What is it saying? This is equal to 50, this one. Why is it saying fall? Or not there, I put the wrong one. I think I put the group retained earnings should have been the one which should have been. This is NCI. NCI is the one which is 50. So we are saying NCI, after we reduce, it had become 240. Now we are going to add 50. So if you look at this total here, it gives you, I think is 590. If you remove 300, it gives you 290. So that is NCI, and then the group will take the share, the lion's share of 80%, which is 200,000. This is only post-acquisition earnings from the subsidiary. And that is, now we go to 2015. 2015 is going to be shown separately because it's going to be through the movement in reserve. So example, we can now work out what the, let me work out the journal first, then we go to how we will deal with restructuring the statement of changes in equity. Okay, that is not what I wanted. I wanted all borders. Yeah, that's fine. Now I want to put the journal for December 2015. So we are basically saying up to 2015, the ratio remained the same. It's still 80-20. The change will only happen at the end of 2015. Only on the last day is when they will dispose of 20% and NCI will become 40%. But during the year, it's still 80-20. So we are going to say that this company is going to make a profit of 150. And that 150 in the end will have to be distributed. But we can try and make a statement of profit and loss for the year, and then we see what will happen. So ideally up to 2014, we should have our balances of what we should have. Let's work out what the consolidated statement should look like. I want to do a consolidated statement of changes in equity, and you know what that entails. Let me put it there, then we entail. When you are told to do a comprehensive statement of changes in equity, we know one, the item that must be there is one, the ordinary share capital, which is always there. Then we have the retained earning. Then you have the total equity, but now I will combine for the purpose of time. And then you have total equity and NCI. Ideally, you should get this and this. You have a total owner's equity, then you have NCI, then you have total equity, owner's equity, and NCI. That's how it is. And then just for the purpose of showing something, we have, this is for 2015. I'll say this is the one we'll do is for 2015. So we want to work out how it should have been, and then we will know. So we can go and work out before we do the 2015, which we can do the statement of profit and loss and take the movement there. So what we want to do is on the 1st of January 14, the ordinary share capital that we will have is the ordinary share capital of the parent, because the one of the subsidiary is eliminated. The retained earning that will be there for let's talk about the group retained earning that will be reflected in the consolidation will be the parent plus the share of the subsidiary. So what is the parent one? The parent one, we can pick it directly from the statement here. We know on the 31st, it is 1 point, but here we need to split again. We know this is 2 years. We need to know what the year is. Let's work it out based on what the parent made. So based on the sentence there, the last one said, the profit after tax for the year to 31st was 300,000, and Soliv paid a dividend during the year amounting to 50,000. So the profit after tax was 300,000. So what do you think is the figure there? If you remove 300, what went to the net effect? I'm not sure when they say the retained earning of the parent at the end of the year. So I would say it is the 300 is what they did, but they also paid a dividend, and therefore their retained earning changed by 250. I think it's a way of, you have to make, which assumption do you want to say they made 300 and 300 went to the statement of changes in equity, or it's 250 because they made 300 and 300 you net the dividend they shared, and therefore we are saying, is it 250 or 300 here? Which one should we do? When we say the statement, ideally what goes to the net to increase the statement of changes in equity is the net. And therefore we are saying out of the 300, only 250 has increased in here. So if we have 2480 as the total, then we remove 250 because 50,000 is already given out. Then we are saying the balance brought forward is 2230. Let me work it out. We are saying the figure is 2480, and the previous figure is 1800. 2480. So I say it's 2480 is the retained earning. This retained earning has been offset with 250, which is 300, the profit for the year minus the dividend they have paid in the year of 50,000. So we are saying the balance that then should have been brought forward at the beginning of 2014 should have been 2230. So we are saying the balance brought forward for the parent in terms of retained earning was 2230. 1, 2, 3. That is earnings attributable to the group only. What about their share of post-acquisition earning? So we can work out what the total is up to 2014. I think we have worked up to 2014 here. Yeah, when we did the 200. So if we work it out, we can say that that is the profit that will be added to the parent. So we can say the post-acquisition earnings is that one, group retained earning, is that amount. And therefore we are saying before the group retained earning brought forward would be that amount. And therefore, we can say the group retained earning is 27,500. NCI, now let's work out what NCI is. NCI, we know the total here. We can add up what the total is, minus 300. Minus 300, 1, 2, 3. And therefore, we know the balance brought forward at the beginning of the year is 290. And therefore, we already have our opening balance, 290,000. That is the NCI at the beginning of 20.
Hello, doctor.
Yes.
Could you please explain that? How did you get that 505,000?
How did I get?
The 505,000.
505,000 is all the post-acquisition earning arising from the acquisition of the subsidiary. And I went to what we were doing, the journals and the ledger. I said on the 31st of December 2013, we shared 55% of the profit of 275. And then 30,000 was the gain in the movement in reserve when they gained an additional 25,000 shares. And then we have said up to December 2014, they own 80% of the subsidiary, and their post-acquisition earning is equivalent to 200,000 based on the journal. So that is what I've added up the three items to give me 505,000.
Okay, thank you, doctor.
Okay, so now we have said we already have the balances for opening balance. I think this was the most important, and you could work out what the total is there. That is the total for there. Then we want to do the profit for the year. How do we do the profit for the year? We have to do like a consolidated financial statement. How do we do the consolidated financial statement? Let's see the group, what the group made in the year. And the group, we already know they made 300,000. 1, 2, 3. That we already know. That's what the group made. What did the NCI make? For 20, remember we calculated for us to share the 250, we left 150. So we are saying the group, the NCI made 150 because we said of the 400,000. Here, let me go back to the question for it to be clear. We are saying from 1.1 to 1.5 is 400,000. But we are saying for 2015 alone is 150. Therefore, 2014 was 250. And therefore, we divided between 2014 as 250 and 2015 as 150. And that's why I'm saying for that particular year, NCI is 150. And therefore, the total profit for the group, the total profit in the consolidated financial statement will have been 450. Of this, we share it, we attribute it to NCI, and NCI is only 20% of what was made in the subsidiary. So we are saying NCI only take a share of, and then the group will take the other portion. Attribution is the difference, which is also equal to basically the total minus what is going to the. So we are basically saying of the 450,000, 420 belongs to the group, and that be 1,000 belong to the NCI. So we can say the profit for the year, therefore we can bring what the group is having, and we can also take what NCI is getting as a share of 25%, which is, was it 30? Yes. So that is the profit. And if we do the total profit for the year, you can see it is the same, like is 450 shared to between group and NCI. That is just before the acquisition. So we are basically saying, if you close, like here we have, let me add some figures here, some entry here, just to work out, to give me myself some working space. Okay, we are basically saying at this point, the balance in the NCI, let me close it here. I put a line and I say now the balance in NCI is 290,000. And this represents 20% because remember, it represents 20% because they were 45, then they sold 25, it is 25%. And we can check. If we look at the NCI at that date, we can do a recheck just to say at this date. Now we are saying the total is 1.5 is a retained earning. So we want to see the value of NCI. We are saying the ordinary share capital is 100,000. The other one is 1.5 million. And the total for both of them, if you add, which is the net asset, gives you 1.6. And therefore 0.2% of it would give you, is it 320? Oh yeah, we have added 30. We haven't added 30. I think it's 290, but we have added this 30. This 30 that where is the 30 we have added at the bottom? Was it 30 of, what happened? Are they 20%? We said 590 was there, and then 290 up to, that was up to 2014. It was up to 2014. So we are using the long net asset. So we need to look at there. So what did we say the net asset was at that time? If you remove to 150, wasn't 1.6. It's basically, let's go back. We are doing this the opening balance, sorry, it's not the closing. It is basically, the profit there is 250, so it's 1350. The retained earning at the beginning of the year is 1350 because 150 is a profit. So we work with 1350 there. So what's happening? Here is where I'm saying we work with 1350. It more zeros than I need. Yeah. So we are basically saying if you look at the net asset at that date at the beginning of the year, NCI is 20% and 20% represent 290, and you can see it is also 290. Then during 2015, we have allocated another, we have allocated 50,000 to NCI, and we have allocated, that's what we have allocated to NCI, 50,000. Again, 2015, that's where we are. So we will say from the group profit. So we are basically saying we are going to remove, let's say from the retained earning of the subsidiary. I like eliminating the retained earning of the subsidiary. So we are saying it is 150, 1, 2, 3. And here, although this is not to be shown, it should be shown. We don't show this. It goes to the statement of changes in equity. So let me not show it here. We'll just show it in the statement of changes in equity. So during the year, of course, the parent made 420. So the 420 is everything. And therefore, when we go to the statement of changes in equity, 420 is everything, and this is NCI. So just before, let me work out what NCI is at that point. At the end of is 320. And 320 is the net asset if we, at the end of the year. And that represents 320 represent 20% of the net asset. But on that particular day, after the 20%, we need to look at what is happening in the movement. Again, we go back on the 31st and enter this journal. So we are basically saying that these people are going to sell 20,000 shares. So what are they going to do? And they are going to, let's say, put it in the journal first. On 31st of December, 2015, they are going to receive cash, let's say, or a receivable. Let me put receivable. They are going to have an asset, and they are going to do the investment in associate, because that's what they are selling. They are selling 250,000 and they are going to receive 250,000. That's a journal for the additional. If we go back to our investment, remember this, we eliminate it when you are doing consolidation. Now we have another 250 here, which is a payment, a reduction, which again need to be eliminated. So how do we eliminate this 250 for the purpose of consolidation? So we are basically saying to eliminate that, since it is a credit in the investment account, we'll need to debit our investment with the same amount of 250,000. But what is it going to do? It's going to increase NCI. Let's see, NCI. So NCI, here we are saying NCI was 20%, is 320. NCI is going to increase now from 20% to 40%. So ideally, NCI is going to double. Of course, we can work it out. So ideally, that is easy. We are saying 20 is, so what is 40? So you'll find 40 is ideally supposed to be, the other 40 is supposed to be 640, but we need to add another 20 to make it 40. So another 20 is 320. That's what NCI is going to increase. So this is the journal, the recognition that we are going to increase NCI with the amount of 20%, which is 320,000. Again, there is a difference. What do we do with this difference? There is a difference of 70,000. But now you can see this, we are going to take it to retained earning. If we go now and reflect that movement, is that we are basically going to show movement in reserve. This is the movement in reserve. So we are going to increase NCI. That was the total. We are going to increase NCI with 320,000. And we are going to reduce this one by minus 70,000. And the difference between these two is what, of course, eliminates the investment, the credit investment. And therefore, to get the balances as at 31st December 2015 is basically just to add these figures. So we have the 300,000, the group retained earning is that amount, and the NCI is 640, and that is the total. Very comprehensive example. I haven't looked at the solution, but I think we have done it well, unless there are assumptions that we made that are not made in the solution. I don't know. I hope we can all do these questions together. Any questions so far? Okay, let me save this. I'll post it in on e-learning just in case you want to see the working, but let me just put it in where it's supposed to be. Then I don't forget it. And I put it under this module. I say, I'll call it distance piecemeal exercise. Okay, I hope we have done it. We understand. You understand the journals that we have passed and why we kept on. This one now is the last one that has led to 250,000 is what has led to the final 70,000 there, because we are saying they now sold. Yeah, they sold assets, net asset worth 320, which is a 20% of the net asset, but they only received 250, and therefore they made a loss of 70,000. And that's 70,000, but we also forgot something else. Yeah, there was dividends that were paid, which we should have put it there, which is 50. Were they 50? Yeah, they were 50,000. So that is how the figure is. So this is something that we had forgotten, but we were given the information that there were dividend paid, and the dividend is what is paid from the parent. There was no dividend paid to non-controlling interest. If NCI had paid, we would only have recognized only the payment made to non-controlling interest. Any question? Hello, you're too quiet. You can see we have handled the question in full in about an hour. So if you are not explaining, you are writing and you have highlighters, and I always advise students that it is important to have highlighter. You can see how I use Excel. I use greens just to ensure what I've taken into consideration, what I haven't taken into consideration, and to follow up. So ideally, that is what is expected. So you saw in there, when they acquired additional interest without change of control, we considered what NCI gave out by debiting NCI and what we paid and determined whether there was a gain or loss. Again, when we are disposing of, ideally it is NCI that is increasing, which is this NCI that is increasing. So we say NCI is gaining net asset of 20% asset, but they are only paying 250, and therefore we recognize the loss in the group. That's why we have said we have recognized. So if this had happened in the prior year, because we wouldn't have shown it here, you would have shown it in the brought forward. I put this movement because we are showing the statement of changes in equity for 2015. And therefore they must be shown as separate item. The profit for the year, which is what we put here. I think I put it in the wrong place. We should have put profit here for the year, and that's what we do. Let me just do the summation. You see the profit is 450. If I do summation here, you'll see it is on this column here. You will see what it does. It gives you a 250, yeah, which is represented by the investment in associate. So there is a movement of 250 in reserve. That's why you see the total movement is showing a 250. So we have received, and there was a 70 and a 320 and a net movement, which is the investment. So that is how we account for it. Any question? Okay, now the next thing I want to do is basically look at the consolidated statement of cash flow. And I've said today I basically want to look at the one that is indirect. So I'll use the same Excel. Let me call them PM there, or let me call it piecemeal. Okay, so I will post this to help you in revision. Why did I start the thing too high up? Why do we start too down up? Was there any reason? I don't think there is any reason. I think we have everything there. So now we can look